Okay, so I hope everybody had a nice bank holiday, enjoyed the weather. Just a quick note, so I updated some of the numbers that go into the plots from the end of last week so that the plots, or the numbers, correspond to the pictures, which is in David Lando's book, chapter 1. So today we're finishing chapter 1, the last structural models class. So that takes us up to page 50 or 60 in this book, if you are following the book, which is a good book. And next week we will move to intensity models, which is chapter 5. Okay? So that's the first note. And so today we are looking at our final extension to... Oh, that works. Cool. Our final extension to the structural models Merton framework. So we're going to look at jumps this week. But before we start, are there any questions? Maybe questions with regard to the problem set? Everything clear? Good. All right. So, strategy for today is that we're going to now see a new type of continuous time finance, which I doubt many of you will have seen, or any of you will have seen. And the idea is not to necessarily understand deeply the math, but really to just have a conceptual grasp of what's going on. So, again, if you can simulate stuff, then you can understand stuff, is my philosophy. So today, we're going to look at, review again with more problems with the Merton model. This week, we're going to be focusing really on the short end of the term structure and try to understand what's driving the very short-term credit spreads. And we're going to look at one extension which tries to understand this, which is that we extend the Merton model to include jumps in asset values, and that's going to change an awful lot of things. So if you allow discontinuities in the process for asset values, you can think about suddenly your technology, you're running a company, you're a manager, you have a technology, and all of a sudden that technology takes a massive shock because maybe one of your competitors, for example, invents a new way to develop things. So in the back of your mind, this is kind of the big jump in asset values that we are thinking about. So this is going to work to some extent, but we're also going to look at some alternative explanations and corporate bond in the corporate bond market. So taxes play a role in the corporate bond market. There's also issues with liquidity. Probably we're not going to get onto this week, and I'm going to cover the KMV Moody's model next week. All right, so more problems with the Merton model. So when we think about things in terms of the option pricing framework, we are thinking about the equity holders having a call on the asset value and the debt holders being short a put and long a risk-free bond. So when we are doing credit risk modeling, we're implicitly assuming that we know what the underlying value V is. Okay, so it's like if you think about you're valuing a stock, we know what S is, right? We can look at our Bloomberg screen and we can see what the value of the stock is today. When we're doing credit risk modeling, our implicit assumption is that we also have this. We know the current liability structure of the firm, so we know what its debt versus equity is, and we can observe V. We know the asset value. We know the volatility of the assets. Okay. But in reality, we don't. Okay, so this is one of the problems with the Merton model, and this is something that the Moody's model tries to fix. Okay, so in the back of your mind, we're using this Merton, we're using this idea that you can value things in option pricing framework, but really there's a small twist there that we don't observe V. Okay, so it's going to turn out that we don't need to observe V actually in reality, because if it's enough that people trade on it. If people trade on it and firms issue equity and debt, and these are traded assets, somehow we must be able to, well, somehow you should be able to infer what V is. okay, by some sort of magic market tricks. That's essentially that's the main contribution of Moody's, is to trying to back out what the asset values is and use the Merton model. Second new problem, is that defaults are predictable. Because of the assumption of a smooth price process, if I know that at some point I'm well below the default barrier, I know what the probability, I can compute exactly what the probability of default is. So we say that defaults are predictable. I actually know with certainty that they will happen, or I know with a certain probability that they will happen. Recovery rates, also predictable. How much do I recover? Well, if I'm the debt holder, I recover the difference between the asset values, which are predictable with a certain distribution, and the level of debt. So this creates a whole bunch of problems, because in reality, if default was predictable, debt holders would run away. They would run away well before default. We don't actually see that in the data, and so it cannot be that default is totally predictable. How are we going to fix that? Well, it's really it's going to be the fact that default is predictable is really a consequence of the smooth diffusion process, which is why today we're going to look at jumps, and next week we're going to look at jumps even more. So the reduced form framework is really built around this jump to default, jump diffusion framework. Okay. Now it's going to turn out to be the case that even if you are above the default threshold and you have a time to maturity is very short, if you do allow for jumps in the asset value process, default no longer becomes predictable. So it can be the case that you are solvent, and with some probability you're going to experience a very large negative shock. And that's going to be basically the key thing that that's going to be key to understanding how the short term of the credit spreads term structure behaves. Okay, so jumps, predictability in defaults, and short-term credit spreads are intimately linked, and we're going to work on that today. Okay, third problem, which we're never going to get to, but there's a whole chapter on it. So chapter 2 in this book is a very famous model which takes a different extension to the Merton framework, which is that debt holders have incentives in this model to force bankruptcy. Okay, so if they know that the manager is behaving badly, is being a bad manager, they might want to force bankruptcy early, right, because it could be beneficial for them rather than delay and possibly have a lower recovery value. So there's a tension in this model between debt holders and equity holders. The equity holders, what do they want to do? Well, because they are long the options, and the debt holders are short the options, they're going to want to try to do risky strategies, misbehave, and they're going to try to want to do that even more when the asset values are low, when the firm is being unproductive, or when it has high debt. Why? Because they have an incentive to chase the money, right? So this is what the equity holders want to do, and on the other side of this, because the debt holders know the equity holders have this incentive, there is an incentive for the debt holders to try and force bankruptcy early. So this is like really the classic way to start thinking about how capital structure and corporate finance and asset pricing link together. So there's a very famous model by Leyland, which takes the Merton model and derives some optimal capital structure implications. Okay, so we're not going to look at that, but that's something that you could definitely look into if you were interested. Leverage ratios. Okay, so also the Merton model predicts that leverage ratios are, to match credit spreads in real life, it predicts that leverage ratios are very, very high. Like firms are very, very levered. And in reality, they're not. Okay, so in reality, many firms have low leverage, and actually there are some firms which even have zero leverage. Some firms don't take on any debt. And that's a puzzle with respect to the Merton model as well. Actually, these are really interesting firms. So this is This reference here is good for these firms which have zero leverage firms. They're sort of very strange firms. All right, so short spreads. So I'll focus for the next hour. Short-term interest rate spreads are non-zero, okay? They're non-zero, and they move around a lot. So the classic example would be the London Interbank Offered Rate, LIBOR, the famous rate which was fixed slightly. So it's a lending rate between a bunch of banks. So it stands for London Interbank Offer Rate, and it's an average of an interest rate which a bunch of banks are lending to each other overnight. So normally it's very small, tiny. But in the crisis, it got massive. But even in most times, LIBOR is not, the LIBOR IOS spread, for example, the difference between LIBOR and the overnight index swap rate is non-zero. Okay, so that would be your classic measure of funding risk. Okay, so one is a collateralized lending rate and one is an uncollateralized lending rate. So one is riskier than the other. Merchant model is going to predict that that spread is zero, right? Because on a one-day horizon, what's the probability that a bank is going to default? Very low. Okay, so what is driving these massive spreads that we see in the crisis period? Okay, the benchmark merchant model cannot understand that. So why is it that the merchant, so just like to warm up a little bit, why is it that the merchant model does predict these spreads going to zero at the short end? There's a subtlety here. So it's not that the probability of default goes to zero as the time horizon goes to zero. It does, but it's the reason is that the probability of default goes to zero faster than the time goes to zero. Okay? There's two things happening here. So the first question is, why is it that the spread goes to zero, S standing for spread, when tau, time holding period of debt, goes to zero? And it's really the consequence that it's the rate at which the probability goes to zero faster than the time to maturity. So, definition. Basically, a continuous diffusion is one in which has this property. A continuous diffusion, X, is one for which, if I take the difference between 2 points on that path, now and tomorrow, and I make that difference very, 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 very small, it goes to a positive number as this difference goes to zero as the horizon gets very, very small. Okay, so this is the probability. This is not saying that the diffusion is not moving. It's just saying that if I zoom in very, 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 very tightly on this, I get to a point on this path. I can trace my pen on the path. Okay, now what does that mean? Well, what does that mean is the following. If you think about what the price of a bond is, a default-free bond, well, a default-free bond is, under the risk-neutral measure Q, it's just the expected discounted value of the face value of debt D. So this is just a world with constant interest rates. So long as so long as 1 stands for, it's just a 1 when the asset values are above the face value of debt. Otherwise, you get 0. So this notation is going to be popping up all the time from now on. This 1 means it's a 1 whenever the face value of debt is above, assets is above the debt, otherwise it goes to 0. What does going to 0 mean? Going to 0 means the value of the bond goes to 0, so you default, it's a 0 recovery bond. Yes?
Could you go back to the previous slide? The last, the question part.
Yeah.
Is it supposed to be the inequality sign will be that way?
So this is take that away. This just says for any smooth diffusion, there's a positive probability that 2 points are different from each other. So if I take 2 points on a path of diffusion with positive probability, they will be a different number, a different point. Okay? But this says that if you take those 2 points and you take the limit very, 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 very small, they line up on top of each other. Right? So the point mass is 0. So if you think about a distribution, let's think about the normal distribution. What's the probability that you draw 3 from the normal distribution? 0. Right?
Since it's larger than epsilon,
Yeah.
we don't know anything about the inequality.
Yeah, so this all I'm saying here is that if you don't take that limit, there's a positive probability of drawing probability mass between 2 points. Right? With a smooth diffusion, as the limit goes to 0, that goes to 0, the probability of drawing a particular number.
Yeah, the point there is that it goes to 0.
Yeah.
But, yeah, maybe I don't start it in the break, but I would think that the inequality would be the point that would be there was smaller.
No, so this just says that in the limit h goes to 0, the probability that you draw a number that is different, the probability that that number there is different goes to 0, different than 0.
And it's just missing an all epsilon.
That epsilon stands for small positive number, any small positive number.
That's what I mean. It's for any epsilon.
That epsilon stands for small positive number. It always stands. Okay, so this is the epsilon is an epsilon shock. It's any small positive number. So that's just a standard notation for a small positive number. So for any small positive number, the probability that that is greater than or equal to it as the limit x goes to 0 is 0 for a smooth diffusion. That's the property of a small diffusion. The intuition is take a normal distribution, which is continuous. What's the probability of drawing 5? 0, right? What's the probability of drawing a number between 5 and 6? It's going to be above epsilon, okay? As that 5, the distance between 5 and 6 goes to 0, as h goes to 0, the probability of drawing a positive number goes to 0. That's not true with a discontinuous distribution.
Another question. The closing bracket of the property should be probability of x equals h1 times t. It's larger than epsilon.
Yes, there should be a bracket there. Yeah. The h is 1 over everything inside the bracket. Okay, so this bracket should be here, which basically just says, as I make the limit very, 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 very small, the point mass of drawing a number goes to 0. That's with the continuous distribution. That's a property of the continuous distribution. If x had a non-continuous distribution, as h becomes very, very small and I try to draw a single number from it, if I end up in a discontinuous part of the distribution, the probability does not go to 0. That's the important part because that means that, well, imagine that we're at xt today and h is just a very small period away from each other, just one day ahead. If h is 1 day ahead and I'm above the default threshold, the probability of drawing a number which is below the default threshold goes to 0 as h goes to 0. With a jump, that's not necessarily true. Okay, so maybe the confusion is this needs to be that there's a second bracket that should be there. So that 1 stands for, well, it's just always a 1 for when Vt is above D. So it's the expected value of 1. Okay, so what is the expected value of everything here is a constant. So just bring this out. This is a simple model where constant interest rates, face value of debt equal to D. So just take that out. And now, what is the expected value of that 1? The expected value of that indicator function is just the probability that at maturity, VT is greater than D. Remember, this is a model where you can only default at maturity. Okay, so the expected value of that 1 is just the probability Q that V is above D. So, if we live in a continuous world where this is true, so I'm going to use this property now, what is the spread? All right, the spread in this model is just the yield. So this is the yield minus the risk-free rate. So if you take the log of this and plug it into 5, the interest rate here cancels. Okay, so the spread cancels, and you end up with 6. So 6 is the bit which starts. Okay, so this is an important part. So what is this? The spread is going to be log of this probability. Log of this probability, V being greater than D. Indicator V greater than D. VT greater than D. So this log Q, is approximately Q minus 1. Okay, so there's a small log approximation there. This is the first order Taylor expansion. And now, well, the probability of Q being VT being greater than D minus 1 is the same as the probability of Q VT being less than or equal than D. Okay, so this is like that number there. So Q minus 1 is the same as 1 minus, well, the probability. If you think about normal distribution, the probability of x being greater than 1.96 is 5%, which is the same as 1 minus the probability that x is less than minus 1.96, right? So now we end up from here, small approximation here, and this is our key quantity, okay? So the spread in a smooth diffusion model is approximately equal to this. And then we think about what happens to this probability as h goes to 0. The probability, so as h goes to 0, because of this, with the bracket there, this probability, any probability as h goes to 0, will be going to 0, okay? This term, however, goes to infinity. So I have one term going to 0 and one term going to infinity, but this term goes to 0 faster than this term. Okay, so you can tell, you know by the property of the continuous distribution that this goes to 0 at a rate, where you can show that this goes to 0 at a rate faster than 1 over h. Okay, so it's not that the probability goes to 0 in the limit. It goes to 0 fast enough that this whole thing doesn't explode. And the spread will always go to 0 in a smooth model. Okay? So regardless of the interest rate, time variation in the interest rates, regardless of whatever you do, if you start with a world which is continuous probability distributions, you end up with a world in which spreads are going to 0, which tells you that jumps must, or discontinuous distributions must matter. Because we observe in the real world that the spreads are non-zero. The LIBOR IOS spread is non-zero. Therefore, you know, in this Merton world that we live in, there must be something to do with jumps. Discontinuities in the asset value process, in the firm value process, or otherwise known as jump to default risk, must matter. Okay, so that's what we're going to look at now. We're going to look at the classic or the benchmark jump to default risk model. Again, it's due to Merton. There's two types of jump risk in the world that we're going to think about. There's going to be direct jump risk, systematic jump risk. Okay, systematic jump risk is that you hold a portfolio where all of the firms suddenly experience a jump. In this case, you cannot diversify away the jump, and so you're going to demand the price of risk for it. You're going to demand compensation for it. The second type of jump to the first jump to default risk is non-diversifiable jump risk. Okay, so we're not going to look at this because this gets tricky. Taxes. Okay, later today we're also going to look at some alternatives to the jump model, which is taxes. Taxes play an important role in the US because there is a different tax rate on corporate bonds if you are an individual versus an institution. Liquidity risk. Corporate bonds are not very liquid. And that's like one of the data issues here. One of the reasons people trade CDS and they don't trade the corporate bond market is because of the corporate bond market being very illiquid. So it's super difficult to trade these company bonds in reality, and so liquidity risk matters, okay? This is for next week. All right, so, well, as part of the coursework, one of the options is to also simulate this model and show me you know how this model works. So there's going to be a closed form solution to what we see today, okay? The punchline of this is going to be that once you introduce jumps, credit spreads are weighted averages of Black-Scholes prices. It actually turns out to be relatively simple. But you can always just simulate this model. The easiest way to do this is to simulate, okay? That gives you, going to give you an idea of exactly how things work. So, equation 10. Equation 10 is the starting point from where we begin. It's the firm value process. It going to look slightly different than the normal geometric Brownian motion. So, this stuff here, the mu, so this is a firm, you think about it being a gold mine or a technology firm, however you like. V is moving around due to a continuous component, the Brownian motion, which has some payout ratio mu, the dividend. Everything else relates to the discontinuous component. So let's take it one step at a time. The discontinuous component, the jump part is this. Okay, so this is a jump to diffusion model. This is a jump diffusion model for the asset value. And the jump component has two terms itself. It has this gamma multiplied by this n, dn. So what is the dn? Well, so this is the Brownian motion. This dn is a Poisson process. It's a counting process. So it's simply equal to, it's called a counting process because it just counts. It counts the number of jumps there are. Okay, so dn can either take a value, at every point, it's either 0 or becomes a 1. Okay? So if there's one jump in a year, this would be a 1. If there's 2 jumps in a year, this would be a 2. If there's 5 jumps in a year, it would be a 5. Okay, so that's why we call it a counting process. When do the jumps occur? Okay, well, the jumps occur, they have a Poisson distribution. So that's what we call it, a Poisson counting process. The time between jumps is going to be exponentially distributed. That's the definition of a Poisson process. So this counting process is just counting the number of jumps, and every time there is a jump, what happens? Every time there is a jump, the size of the jump gets drawn from a distribution gamma, which is some function y. Okay, so some function of a distribution of. So gamma is some function of y, and y it's going to have some distribution. So y, for example, could be normally distributed with a mean 0. That means if in 1 year there's a jump, the jump gets, what is the size of the jump? Well, it could be positive or negative, right? And it can take anywhere on that normal distribution. So that would be a normally distributed jump. So jumps can be positive or negative. Okay? Jumps are going to have a distribution themselves. So, what's the probability that, okay, so now this, we're in a world, we have a smooth diffusion, and all of a sudden there's going to be a big asset value jump. What is the probability that in any instant there is a jump? We call that the intensity of the process. So the Poisson intensity is the probability that in the next instant there is a jump. That jump probability can be time varying as well. We're simply going to, in the rest of today, we're going to look at the simple case in which lambda's constant. Next week, when we look at these reduced form models, lambda's going to be time varying. So lambda's the Poisson intensity. It tells you the probability of a jump in the next instant. Now, if there is a jump in the next instant, let's think about what happens. There's going to be a discontinuous change in V. How big is that change going to be? It's going to be equal to dV, the change in asset value, is going to be equal to V multiplied by this animal here. So V times the animal there is this. That's going to be the size of the jump. Where y is simply this gamma is going to be a function of y, and y is going to be take some distribution. So what happens? Okay, so in general, like the math here could get difficult, but we're taking it simple. The plus and the minus, so the t hat is called is the jump time. How does the asset value move 1 instant before minus to 1 instant after the jump time t? It's just going to be this difference here. What is going to be the v in the next period? V in the next period, well, and that's going to be equal to gamma times v in the previous period, okay? So this is the jump change. The jump change is going to be equal to this animal here, which tells you, if you just simply rewrite this, bring over the v to this side, you see that the level that the asset value jumps to is going to be equal to the previous level multiplied by this 1 plus gamma. Okay, so this 1 plus gamma is going to be important because that's going to help us choose. We're going to choose it now. We're going to choose a gamma, which makes sense. So gamma can be anything, right? We're up to us to choose gamma. If you look at 14, what is the simplest possible gamma you can pick to make this, like, how could we simplify 14? You can pick any gamma you like. It's up to us. What one would you pick if you wanted to simplify 14? Remember, gamma is just a function of y. That would be very simple. There would be no jump then, right? And then we'd be back to a very simple world. So, okay, so anything other than 0? Heard something? Y. You could pick Y. It would be simpler to pick Y minus 1. If I pick Y minus 1, things are going to work out simple here, right? Things are going to be simply, the jump in the next period is just going to be proportional to Y. So actually, that's what we do, okay? So what I'm going to do in a few slides' time, I'm going to choose a gamma. I'm going to pick Y minus 1. Why do I pick Y minus 1? I pick Y minus 1 because of 14. So if I pick Y minus 1, that's a function of Y. It's just, this is going to be Vt, Y, Vt minus. Okay? So you can think about this from the start. I could have picked Y minus. I could have typically. Okay, so I'm trying to ease you into this. Normally, what would happen? You'd see this equation 10. You'd just see Y minus 1 up here. People would just write Y minus 1 here. Why do they write Y minus 1 here? Well, because if you write out the algebra a couple of more lines, you see if you pick a Y minus 1, you end up with a very simple jump component. Okay? That's where it's coming from. That's where it will be coming from. Okay? All right, so this is just one part of it that's new. The second part that's new, if you take a look at this again, there's another component here, right, to the jump. This is the jump part, but there's a new bit in the drift. There's a new part in the drift, and that's equal to lambda k. Why do we have this part in there? We have this part in there for the following reason, that we want the expected value of the asset price process to be equal to the dividend payout, mu. So we want the expected value of that thing to be equal to mu for it to make sense. So what is the expected value of this thing? It's the expected value of the drift plus the expected value of the Brownian motion. What's the expected value of the Brownian motion? 0. What's the expected value of the jump component? Well, the expected value of the jump component is, so that's the 0, the expected value of the jump component is, well, the expected value of the Brownian, the Poisson process, the counting process, that's lambda dt, because with probability lambda t is equal to 1, and probability 1 minus lambda dt is equal to 0. So its expected value is equal to lambda dt. So that's lambda dt, and we just define the expected value of this jump distribution to be equal to k. That's just a definition. So the expected value of this animal here is lambda dt times k. So now if you take a step back, well, I started by putting it in the drift, because then, once I compute the expected value of this whole thing, it cancels here, and I end up back with mu. Right, you see this backward way of doing things? So that is basically how we set up this. This is the basic setup of the jump diffusion process. There are two new parts. There's the counting process multiplied by the jump distribution. We're going to pick that to be y minus 1, where y is going to be normally distributed. And there's another bit which you called the if I take this over here, it means this plus this is a martingale. It doesn't have a drift on average, which means once I do the algebra, I end up with this animal here. Okay, that's the basic setup, how things work. So the lambda k compensates for the jump component in the diffusion. In general, we could pick any jump diffusion process gamma I like. I can pick any distribution for y. And I could have multivariate settings with multiple jumps. We could also choose lambda, the intensity of the jump diffusion process, to be state dependent. So it could be a function of GDP, for example. There are more defaults in recessions than expansions. And that is actually what we are going to do next week once we get to this simplified reduced form models world. So if you're working in an investment bank or you're in a credit desk, this is basically what you're going to be doing. Where does these reduced form models come from? Well, the idea of these reduced form models in general is that they come from a world which is this. Okay. Right. So now the cool thing, Ito's lemma for jumps. Ito's lemma for jumps is all you need now to be able to solve the model, and it looks very similar to our old Ito's lemma. So we're going to think about C standing for call option in this case. Okay, remember what happens is that Ito's lemma gives you a way, so you cannot compute the derivative of a Brownian motion, but you can compute the derivative of a function of a Brownian motion. Okay. In the same way, you can compute the derivative, but you can't compute the derivative of a jump process. You can also, turns out, there is an extension to Ito's lemma which includes the jump. And it's relatively simple. So, if we just take the continuous component, that's the top line here. Okay? So the top line here is just the standard Ito's lemma done on the call option. So first derivative with respect to time, dt. There's no time component here. Second derivative with respect, first derivative with respect to v times dv. Second derivative with respect to v times a half dv squared. All right, so that's what gives us here. Okay, so here's the time derivative. This part here, Okay, the Ito's lemma for the jump says that on a jump, so dn equals 1, what happens to the call price? Well, the call price is going to change by an amount equal to this. This just says that, well, the V jumps from V to 1 plus gamma V. And the call is just going to be a function of that. So this is just the jump component of the call. So there is no Ito's correction type term. It just literally jumps and it's a function of it. Where did the 1 plus gamma come from? Remember the 1 plus gamma came from here. I'm going to simplify that in the following. Okay? So this is, you know, relatively simple. When V jumps, it jumps to 1 plus gamma, and so the option price jumps from C to C 1 plus gamma. And that's the jump component. Okay? So, now to simplify notation, let's call everything in the drift, so all of these dt terms, collect them all in the drift, and call it mu c dt. Collect all of the diffusion components and put them in sigma c. So it looks like a diffusion process. And, okay, so this is going to be that it has a drift and a diffusion, the expected return this. Now, let's simplify things. In general, this is going to be super complicated to solve, okay? In general, this becomes a really horrible problem. Except if we make some simplifying assumptions, which is what Merton does in this paper. He says a few things. Okay, so it's the standard Merton setting extended. He chooses gamma to be equal to y minus 1 for the reason that I've already highlighted. Okay. In which case, this will be the jump in the asset value when dn goes to 1. We assume further that this y minus 1 are IID. So the distribution at any point in time is just y. So it's a stationary distribution. If I look at that process at any point in time, the distribution over time is just IID. That's what the IID stands for. Identical independent distribution over time. Now, if this is true, and these are IID over time, it turns out that the solution to this thing looks very much like the solution to a geometric Brownian motion, except there's this additional part in here. If these assumptions are true, it turns out that the solution to the diffusion process is equal to this. So if you turn this off, okay, if you turn this off, remember the gamma we chose to be y minus 1, if you turn this off, you're back to the standard solution to geometric Brownian motion. This just says that the solution is the same solution, except you add in a sum of these log of the distribution. Right? So there's an exponential here. So you could either write this as with a summation in here, or you could pull it out and have it as a product of y's. Okay? So I've pulled it in, and that's why I get the logs. And if you have a note, if you notice here, this summation is between 1 and the number of jumps which occurred. Okay, so at some point in time t in the future, going from 0 to some point in time t in the future, there's going to be a continuous component. There's a deterministic component. There's this continuous normally distributed shock. And then there's a sum of jumps. Okay, that's kind of intuitive. How does it look like? Right, so there's one more simplifying assumption. What is the distribution of y that we should pick? Well, the easiest thing it can be anything in general, but the easiest thing we can do is simply pick the log. So I'm going to choose the distribution of log y. I'm going to choose the distribution of log y to be normally distributed. Okay, so if a variable is log normally distributed, this is what I mean. This is when we say a variable is log normally distributed. This is what we mean. we mean that the log of the variable is normally distributed. It's going to have a mean. I'm going to say the mean is equal to alpha, and the variance is equal to sigma squared. Okay, so here's the standard normal distribution trick. Why do I have the mean alpha minus? So this is the mean. Why do I pick the mean alpha minus a half sigma squared? I do that for the following. That if I compute, remember here, there's an exponential of my log variable. So somehow, if I'm thinking in the future, I'm getting to the point I want to compute the expectation of this v, I'm going to be computing the expectation of e to a log y. Expectation of e to the log y is this thing. Well, that's going to be just the expectation of e to the y. Well, the expectation of e to the y is simply going to be equal to, well, is equal to the expected value of e to the x. So this is the normal distribution. So this is called a moment generating function. The moment generating function is this, e to the ux. So that tells you, it's another way of summarizing a distribution of x. For the normal distribution, this is a trick we always use, all the time. The expected value of e to the x, if x is normally distributed with a mean alpha and sigma squared, is equal to e to the mu plus a half sigma squared, delta squared. So that's why we like normal distributions. One of the reasons why we like normal distributions is because they are easy to compute the expectation of stuff. Right? Via this trick here. So now take a look at that, and you see why I picked the delta squared to be in the drift, in the mean. Right? Because if I pick a half delta squared in there, when I compute the expected value of y, the half sigma delta squareds cancel, and I end up with e to the alpha. E to the alpha means I can simply redefine. It means that if I want to compute the expected k, remember, was the expected value of this distribution. So the expected value of y minus 1. It allows me to rewrite. We know what the expected value of y is. The expected value of y is equal to e to the alpha because of this assumption. And so alpha is going to be equal to log 1 plus k. Okay, lots of algebra. What does it mean? What does it mean? After you stare at these equations a little bit, you'll realize that so k is equal to the expected value of this jump, y minus 1. If k is less than 1, sorry, if k is less than 0, right? If k is less than 0, then this log, this can be log of a number smaller than 1. Log of a number smaller than 1 is negative. Okay? This should be a 0. So if k is less than 0, then alpha is also less than 0. Log of a number less than 1 is negative. Log of a number greater than 1 is positive. So if you think about this thing, you can think about things in terms of k or alpha. Just going back to what the diffusion process is. Remember, we've picked y minus 1 here. So we're in a world, there's a continuous diffusion, and all of a sudden there's going to be a jump. Is that jump going to be positive or negative on average? Right? Well, that depends on the distribution of what y minus 1. And what do we care about? Well, we're thinking about a world where there's a firm whose assets can suddenly drop. So on average, there can be a very large negative drop. So what do we do? What do we do then to pick, how do we choose that jump distribution such that there'll be a large negative drop? On average, pick any k less than 0. Pick any k less than 0. How do I pick a k less than 0? Well, if I pick an alpha less than 0, k will be less than 0. Okay, so this just says that the jump distribution here, if this is negative, if alpha is negative, then the jump will be a negative jump. All right, so you can go away and stare at those equations, and then if you code this up, then you'll have a more intuitive feel for how it works. Remember, how did we generate this simulation of a Brownian motion? I called it a Euler discretization. So it's just a first order approximation of the SDE, and we simulated it by this, right? So we just said, look, for any Ito process, you can write it out approximately like this thing, and then how do you simulate? You just do like this iterated thing where, well, I start at one point in time, I draw it from a normal distribution, and then there's going to be a drift component, and there's going to be a random component. And you just iterate that in a loop and generate this sequence of V's. Turns out, if you're going to do the jump distribution, it turns out to be like very similar. There's going to be a continuous component and a discontinuous component. This is the jump that we've been talking about. So how do you simulate this thing? Well, the continuous stuff is just the same as it was before. And now, how do you simulate the discontinuous component? So I would like you to do this for your problem set, okay? But it's, I've given you the option to out. So what do you do? At each point in time in the loop, I basically draw from a Poisson distribution with a mean equal to lambda dt. So the Poisson distribution just has one parameter. It's called its intensity. So remember, dt is the time step. So it's like 1 over 252 if you're simulating a daily thing. So you draw from this Poisson distribution, and then I look at it, and I say, okay, if nt is equal to 1, I've drawn a jump. All right? Otherwise, I haven't drawn a jump. So if I draw from this distribution, what possible values does the Poisson distribution have? How about someone up from the back or in the middle? That nt, if I plug in MATLAB, Poisson, and then give it a mean, what possible values can it have? Yeah, so any discrete value 0 and above. Right, I can draw a 0, I can draw a 0, I can draw a 1, I can also draw a 2. Right? What does that mean? What happened if I draw a 2 here? What would it mean? Well, if I draw a 1, it means there's one jump, okay? And that's going to happen with a certain probability. If I draw a 1, then the next part of it, I say if nt equals 1, then I draw, again, from a normal distribution. Why is this normally distributed thing? That's going to be my jump size. However, there is the case, as your colleague says, that it's any real number can be, any discrete number can be drawn. So if I draw a number which is greater than 1, it's unlikely. But if I do, I just draw 2 jumps. That's what it means. It means in this discrete interval, in this dt interval, there could, in theory, be 2 jumps. If there is, I just draw twice from this distribution and I sum them. Okay? Alternatively, you could just say if nt is greater than 0. Would not be a bad approximation. And how does it look like? It looks like this if I simulate it. So this is me trying to simulate a world where there is suddenly a jump just before maturity of the face value, before the debt is paid off. So this is meant to be something like the financial crisis, okay? This is 2008. Suddenly, we thought we were in a world where the value of the assets, of all assets, had dropped drastically. So, you know, we're living in a nice world. The value of the assets starts off at 30. We think about debt being equal to 20. So in the beginning, everything's very rosy, the firm looks like it's in good health. And over time, so these are the parameters I've picked. So 1, what does the 1 mean? 1 means that there is the probability of a jump in any interval is equal to lambda dt. So the expected number of jumps is 1 per year because it's annualized, right? So if I pick annualized numbers, that's an annualized volatility. That means we expect 1 jump per year. The alpha I picked, was in fact negative. I think there was a negative sign there. Right, so there is a negative jump on average, but it doesn't matter anyway. This is the variance of the jump. So we're living in a world, so everything's good. It's continuous, 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 continuous. And at some point in this loop, I drew a jump. And the jump I drew was large enough that the firm went bankrupt. Okay? So that's kind of the world that we're thinking about living in. Okay? And then we're going to ask, basically, what the credit spreads look like in this world. Okay? If this was the true world. All right. So,
I have a question.
of course.
I didn't understand very well. If you have 2 jumps, well, if it's equal to 2,
Yeah.
that means they happen at the same time.
Yeah.
So you just double the size of the.
Or draw, yeah. You can draw 2 jumps. The difference is, that 10 is continuous, all right? But computers are not continuous, which is why there is a possibility of 2 jumps, basically. And if we do just exactly the algorithm you just say. Just draw twice and sum them. So then you get something like this. Of course, you wouldn't see, even if I'd drawn 2 jumps here, right, you wouldn't see 2 jumps because I'm just summing them on top of each other. And this is the kind of world that I want to think about. Like, if the value of asset values follow this process, what do credit spreads look like? Do they look like how they look in the data? If they do, then we can think about, more fundamentally that firms, the assets that firms have this type of behavior. Okay, and that's kind of important to understand. All right, so just a summary, yes? Yeah, so why exactly? So the jump here, the distribution, I picked the mean to be negative because I want to think about a world where things suddenly get bad. But of course, you could be a world where things suddenly get worse. Better. Right? There could be a world, and there's no reason to believe that one is more. I have no priors actually on whether one is more real than the other actually. Actually, in the end, I think this is not a very good model anyway. I don't think this is the way that the world behaves. I really do not think that suddenly my gold mine drops by this amount, or my technology that I have has large jumps like this. I don't believe this is really the world we live in, but it helps to clarify what could be the entire world. So as you say, however, so I'm picking jumps to be negative because I want to make the possibility of things getting bad more probable. And then I'm going to ask what the credit spreads term structures look like. What about intuition? So if we think about this, okay, so this is again just option pricing, right? What do we think about, if you think about stocks, the equity market, I think it's clear that there are downward jumps. You don't often see the market skyrocket. You don't often see suddenly a 20% return, but you do see large negative 20% returns. And that's why we say that the distribution of returns is left skewed. The distribution of returns has a fat left tail, meaning that there is a small probability there's going to be a large jump now and again. And that's what actually generates this, that's what's partly responsible for the skewing the option pricing surface. All right, so Amazing. Now everyone is an expert at jumps, which is really great, right? So, you know, you did math finance course, and you learnt geometric Brownian motion, and that probably took you 8 weeks, and all in all, we've got 3 lectures, and we've got to jump diffusion processes. So, how does it look like? A summary, this is the only thing that you will ever need to work with. You do never need to know anything more than this. So this is the jump diffusion, simplest jump diffusion model, and anything else is too complicated to really be interesting. What did we do to simplify this animal? I started with 26, and I wanted to simplify it. So I picked K, the intensity of the jump, how often it happens, just to be a constant. And I picked gamma to be y minus 1, y, for the reason I explained earlier, just simplifies things. And K turns out to be the expected value of gamma. Why? Because then, once I compute the expected value of E dVV, I get back the mu dt. In other words, this drift part plus this are a martingale. Option pricing summary is that, well, there is an Ito's lemma for jumps too. Ito's lemma for jumps looks just like the normal Ito's lemma, except it has this additional jump part, but it's not even particularly complicated. And so when you put all of that stuff together, you end up with this, that the option price is also going to follow a diffusion process, but it's going to have a jump as well. But it's going to have a jump component, which looks just like this, except it's going to be a different gamma, but it's going to be the same counting process. What is going to be the gamma? Well, we got it from Ito's lemma. It's just this part here, right? Divided by C because it's dC over C. So this is the equity value of the firm. Right, so this is what equity looks like. So equity is going to have a jump because the underlying assets have a jump, but then the drift and diffusion stuff is all plays out. All right, so questions? Yes?
Just the question about the y, does that have any economic implications? Is it just a parameter of the...
Yeah, you're picking it for convenience. Yeah, normal distribution is simple, but in general you can pick anything. And actually, if you're simulating things, then you don't have to worry about solving stuff. Then you pick any distribution you like. So you can pick funky stuff if you like. Right. Okay. Now I'm going to show you how to. I'm going to run through the solution quickly, and we're going to get to Black-Scholes formula. But that's only going to work in the case of these simplifying assumptions. However, for your problem set, you're free, if you like, to pick any distribution for y you like. Use this. Use 27 because it just makes things simpler. But y can be any distribution you like. So in this loop that I just described, if you don't care about solving stuff in closed form, you just do this. And you pick whatever you like for that. Gamma distribution, T distribution, you name it. Pick a distribution I haven't heard of. And then you're going to just run through this, right? And then how do you solve stuff? How do you solve for option prices in simulation approach? Well, I simulate this, okay? And then I simulate this, and then I say, what's the option payoff? What's the payoff? What the equity holders get? Let's remind ourselves of the economic intuition here. What is the equity holders getting in? Let's say 1 is the face value, the maturity of debt. So we started out at date 0. It was 1 year. It was a 1-year loan for $20. What do in this example here? What do the equity holders get? What's the payoff to equity? Nothing, because this is basically this red line is equal to the face value of debt, right? So if we think about what we would do if we wanted to simulate the solution, you would just, in this particular simulation run, you would say, okay, so run 1, simulate, payoff, equity in this example would be VT minus D would be, in this example, approximately 0. you would do run 2. Blah, blah, blah. Let's say 10. Da-da-da. You did it again, run 3. You simulated it, you computed the payoff at the end, and let's say we got 15. Do it many, many, many times, and you're going to have a bunch of payoffs, right, for equity. The average of those payoffs is equal to the expected value of VT minus D and 0. All right? So if I just simulate this, if I do this really many, many times, I can compute that expectation by just averaging over all of the sample paths. And if I've done that, then I've solved everything, right? I've basically computed the Merton model. Because if I skip a bunch of slides, remember, what is equity? Equity is just a call on the asset values. A call is just the expected value of this max function. Debt is just asset values minus equity, and you're done. So, you know, this is why I sort of think simulation is a very nice approach, because, you know, I can pick any Y I want, and I can simulate stuff, have an intuitive understanding for the way it works. At the end of the day, I can compute expectations via simulation. That's Monte Carlo. Does anyone know why they call it Monte Carlo? Yeah. So the guy who was, so they were doing, it was related to nuclear testing, and they were doing some nuclear testing, and they couldn't solve some stuff. Okay. So one of the engineers had an idea to basically come up with this kind of routine for computing stuff which you had no solution to, no closed form solution to. And his brother was a gambling addict in Monte Carlo, and the algorithm reminded him of his brother, and so he called it Monte Carlo. That's where it came from. Anyway, but this is Monte Carlo. All right, so let's take a break there and ask me questions, and then we're going to compute the closed form solution. Oh, yeah.
So, what I told you, essentially was, just look at the symbol design. Either I will compute
So I think what you're saying is right. So basically, if you think about, well, we have it here, right? If you look at this, so imagine this is 0, right? You basically have, if you're saying that if we're to simulate, you get that is, you would do it like this, with a circle, and then maybe between T and TS, you will see, well, it would be the same, except different volatility. So there would be now plus another Brownian motion, T, WS. Yeah, so it's going to be.
So they're using an indicator function?
It's going to be machine learning. What? Yes, I'm doing.
That's the drift is the same. Okay, so the drift is the
What?
mu 0.
So I'm gonna do the.
Minus plus half.
Yeah, so I get the machine to read the yearly reports.
Yeah, that's going to be T, right? And then there's another one, sigma 2. And W capital T. T and big T. So you think about it being T and big T and some S sigma 1.
So these all captures what you want.
Yeah. So now if you think about the expectation of this thing, right? Well, B is independent from this.
Yes.
So you can do the expectation of this B. Okay. This.
Yes.
Ask a question.
Yes.
So, like, where does this first pressure come from?
So the yield bond prices, right, are equal to well, in the way I have it here, the bond price is equal to this, and this is equal to e to the minus. There's a d here, right? So equal to d. The base value is that e to the minus y t minus t. So log. So then, and then the yield spread is just equal to y minus r. The credit spread is the corporate bond yield minus the risk-free rate.
Oh, okay, yeah.
And this is the bond price is equal to the discounted value of the face value of that, discounted by this corporate bond yield. So just take a log, just take logs of this.
Okay, what's what?
The yield, the
yield.
corporate
Oh,
bond yield, yeah. And y minus r is the yield spread, the credit spread.
Okay, thank you.
Can I ask you a question?
Of course.
But it's about the lecture 2.
It's alright, yeah. Ask away.
Yeah, because I have my notes with the questions there. Section 3. So in here, right?
Yeah.
We talked about how the term structure of non-investment grade debt is downside.
Yeah.
Right? And this is probability that doesn't default before. So shouldn't this be lower?
Yes, this one is the probability that how it's the full time.
So it says that it doesn't default
Yeah.
default before this. So
Yeah.
it's saying it didn't default before 10 years. So shouldn't this be lower than this? Because it should be downside.
Yes, it is for.
Like here it is downside.
Yeah.
Does it mean that it's just back again?
Yeah, it looks like it. This is in the data actually. So
Yeah, no, I'm just asking
yeah.
because we...
Yeah, I had no notice that. It's actually true.
that's correct.
No, yeah, it's just I wanted to ask you for the intuition behind it. And then in terms of the role provisions,
Nice. I'm basically.
they're not hard, so you can remember some styles.
No, I'm going to get. Actually, I will send out after. Yeah. So basically, the Merton PD heading stuff is for you. It's for your own us to understand, right? But no, I'm not going to ask you that. And what I will do is after this class we've done these lectures, we're moving on to new ones. We're going to send around basically a PDF saying. Yeah, like some practice questions which you should expect to be at the level of the exam.
So when you get here, you talk about how PE is deterministic.
Yeah.
Why is it
So the way the trick in the interest rate model is to think about like normally what happens in Black-Scholes is that you end up with so if you look at lecture 2. So normally if you look at the Black-Scholes solution, here you have a KE to the RT. Yeah, you always have a discounted value of the strike in the second part. Now we're thinking about that ER being moving. So the credit spread is going to move partly because of, yeah, exactly. But so that R is going to be time varying. If you think about it, so now the K is not, K does not go into the function, it's the P goes into the function because P is P0 expected value E to the minus.
before we used to have this one B, but now it becomes
This is the same on the maturity.
within the interest rate. So
He's like indicated by it's bad notation actually, you don't need a T in the tau. But basically that tau is zero, and that's zero, it means one, yeah, yeah. I'm saying that when the maturity goes at zero, okay, when we're at capital T, the bond maturity, yeah, so I think it's right. When we're at capital T, the bond maturity is going to be zero. We're at maturity over there. At that point in time, the bond is going to be before that, you are going to yeah, exactly. And that's what we're going to
no, yeah, it's just because yeah, you put all the values charts before I think you have to
yeah, this is the right way around. It should line up exactly with what's in it. They look quite close, so they're not the same code, but they look almost the same. So.
no, it's fine. It's just before even I think even with the drawer.
Oh yeah. It was the wrong way around the name.
And then I think even in the when we talk about the new market now, you use
So the Q was the wrong way around.
Yeah.
And that was flipping that. And I think the main point of this is like everything comes from this slide. Everything is about volatility. And the correlation between them. Because the interest rates going down, if asset values are also going down, then low interest rates, negative interest rates should signal future positive
and is there what conclusion?
This is closed form. Yeah, so this is. So it's literally the same. So if you go have a look at the solution. Okay, so now it's a form. So this is always like our weighted price stuff, right? If you look at the solution, you need two things. Basically, go with this. Basically, put this in a function, right? Pick an R, and you need to quote b squared. Okay. Function. So then with that, you just plug it into this. You need to pick up the parameters. So you do. So essentially, if you pick these parameters, you just get my score. Well, how do you do it? It's a very simple extension to the function.
So like, so how do you have like this last for these three items?
Yeah.
How do you like get this?
You don't need to know.
I don't need
But
to.
you know when you ito, this is ito. This is just a discontinuous ito.
How's this? Oh,
It's an extension of ito's formula. So it basically says when you have the jump part, this is what the discontinuous bit looks like. So the top line is just ito, and then this is the correction for jump.
and what's this brackets? Like C brackets?
Yeah, because in general, what would,
It means like it's a like
That's-
function of this part and
it's a function. Yeah.
and the T.
Yes, it's a function of what's the input going to be after the jump. Well, it goes from V to 1 plus gamma V.
So I don't need to like
No, you just need.
memorize this.
No. Okay, so all right. So what do you need to know? What don't you need to know? So I will send round after we finish this class next week. We'll move on to a new topic which is related to this jump stuff, which are reduced form jump diffusion models, so-called intensity models. I'm going to send round a list of questions, summary questions for these, for all the lectures up until now. So you should expect that they should be the questions that you should be questions of this type you should be expecting on the exam. Right? So the revision questions I would send round, if you solve them now, then you should be good to go for what we've studied so far. Okay? So in general, I'm not going to ask you to go through lots of derivations and stuff like that. So it's not a memory type exam for sure. Clarification, this is the call price. Brackets means it's a function of all of this stuff. So time to maturity. Initially, it's a function of the initial asset value. That asset value on the jump jumps to 1 plus gamma V. That's why it enters as the argument there, 1 plus gamma V. So do you have to know how to derive this? No. I mean, but it's really simple, right? It's the ito. It's this. You just have to remember. We all kind of remember this, right? So you just need to remember this bit if you were to want to remember it. Do you need to know how to prove it? No. Do you know how to prove ito? Probably not. You all know how to use it, right? Same thing. All right. All right, so this is our world. How do we compute the option price in this world? So I'm going to skim through the solution and highlight an important part of this. Again, it's PD valuation. PD valuation approach to asset pricing. Am I going to ask you to do that in the exam? No, but it's important to understand where it's coming from. All right, so in general, there's a bunch of different ways of computing asset prices. The PD valuation approach, how does it work? Well, I'm going to form a hedging portfolio by trading in a bunch of, I'm going to imagine I'm a market maker, I sell options, I drive Ferraris, and I pick up premiums. How do I do that? Well, I sell options, so I'm going to be in general short a call, and I'm going to want to hedge that option. So in the Black-Scholes world, what do? I sell a call, and I try to hedge the option by delta hedging, by creating a delta neutral portfolio, which is self-funding. Okay, and I rebalance at all points in time, such that my long position is offsetting my short position, and if I can do that continuously and I can trade without frictions, then I can eliminate all risk from that portfolio, and risk portfolios should earn the risk-free rate. If they earn the risk-free rate, it's as if assets are priced under the risk-neutral measure, which gives us another way of computing asset prices, right? This is all linked together. Here we're going to do exactly the same thing. We're going to think about hedging this asset value process, or the option, the equity, by forming a hedge portfolio. And what are we going to do? It's the same as the interest rate example. We are imagining a world where we are short the call, and we're going to take some position in. Okay, so I'm going to take some position in the underlying and some position in the option. Okay, so if I was short the call, the omega 2 could be -1, but in general it can be anything. But I'm going to pull this portfolio here, where I'm going to go some amount of wealth in the asset, some amount of wealth in the option, and everything that's left over gets put into the interest rate bank account, the money market account. Okay? So, in general, the money going into the money market account can be positive or negative. Okay, so if I'm borrowing, then it will be negative. I take money out the account and I buy the stock with it. Or if I'm shorting, so if I'm selling stocks, then I'm getting money, I'm putting money into the bank account. Right, so above, we computed all the diffusions for these things. We know what the diffusion for V looks like. It's this jump diffusion component, jump diffusion thing. We did ito on the call. We did ito for jump diffusions, and that gave us the diffusion for this. And so you can plug that all in. So that's just going from here to here. I'm just plugging in the diffusions dV over V and dC over C. Okay? So notice now there are two jump components, right? There's a jump, well, I've collected the jump components here. So there is the normal stuff, the drift, the dt stuff. These things are related to the expected jump sizes. There's the discontinuous stuff. So this is like, we're going to try and hedge this bit out. And there's the jump stuff, which has the jump that's coming from the underlying and the jump which is coming from the option. Okay, so that H, we're going to try to pick the omega 1 and the omega 2 such that H is deterministic. I want to try and kill all of the uncertainty that comes from these bits. That's the aim of the game. Then I'm just left with the drift, which is deterministic. Must earn the risk-free rate, blah, 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 blah. And we solve stuff. However, there's a trick here, or a complication. If I look at this, and this is the interesting thing about jumps from an option pricing perspective, if I look at that equation, and I think, okay, so look, I want to get rid of dW, V, uncertainty here. That's easy, right? Because that stuff in the parenthesis, I just set it equal to 0. I can rearrange this thing. I set that equals 0, pick an omega 1, whatever you like, and solve for the omega 2, which sets equal to 0. That's Black-Scholes. But we're all amazing at Black-Scholes now, right? We're going beyond that. We're going to jump diffusion Black-Scholes. And now if you have a look at this, we're going to want to try to do the same thing. I'm going to want to try to pick the omega 1 and the omega 2 such that I get rid of this jump stuff. So I want to try and set this equal to each other in the brackets. So what I'm going to want to try to do is go omega 1, so this is what the thing that we want to set equal to each other. I'm going to want to do that. So let's imagine that omega 2 is negative, is equal to -1, because I'm short the call. I sold a call option. So imagine that was just equal to -1. Okay. So then my omega 1, in this case, what would I try to do? I would try to pick omega 1 is equal to gamma C over gamma Y, right? Okay, that's the natural thing that I would do, except that this animal here is not deterministic because these two functions, gamma 1 and gamma 2, are not the same function. Okay, so this is what I'm trying to do. We know how to do the Black-Scholes one. This is what I'm going to try to do for this, but it turns out that I cannot do. That's what I would do, but I cannot. Because, yes, the jumps happen simultaneously in the call option and in the underlying, but the relative size of the jump depends on this ratio, a function of a random variable, like the ratio of two functions of a random variable. That is not predictable, okay? That is not predictable because of the function, if the functions are nonlinear. What does it mean? It means that, basically, even if I pick this, I don't get rid of all of the uncertainty. Right? I approximately get rid of it, but I don't get rid of all of it. Okay? So now what we say is, this is why we say markets are incomplete if they have jumps. So market incompleteness. Remember Black-Scholes? So there's a few magical things that happen with Black-Scholes, but I think one of the most magical things is that I said to you about whether the world is whether the world that we really live in, is it complete or incomplete? So in a binomial world, if you can either go up or down, how many states of the world are there? Yeah. So how many assets do I need to complete the market? 2. Now let's imagine the world is normally distributed. How many possible values are there on the normal distribution? Infinite. Does that mean I need infinite number of assets in order to complete the market? No. That's a really cool thing about Black-Scholes is we dynamically trade. If I can trade instantaneously, I only need 1 asset to complete the market per shock. No longer true with jumps. Now we really do have a world of market incompleteness because I can never hedge out that interest. I can never hedge out that risk exactly. That's why we say the jumps make the world incomplete. All right, so the world is incomplete. So what do we do? Well, what we do is let's proceed in 2 steps. First, I'm going to hedge out the Brownian risk for just the Brownians, the Black-Scholes stuff. How am I going to do that? Well, I'm going to pick the hedge ratio equal to this, the standard one. Okay, so if you can think about it being -2, sorry, omega 2 being -1, if you were short the call. Otherwise, in general, you would have this. And if we plug that back into there, you're going to get rid of this component here. What do you get left with? You get left with, this is going to be my hedge portfolio, the diffusion, but it still has this uncertainty here. So if I plug in the definitions of gamma C and gamma, they were above, a few slides above. I had this diffusion summary. If I plug them in, and I use this hedge ratio, approximate hedge ratio, the jump term here, this term here, is equal to this. It's going to, remember, it's basically 0 most of the time. And then when a jump occurs, this is going to be the jump component. How do I get that? Well, the dn is equal to 1. And I just substitute in omega 1 into here, which gives me a minus omega 2. And then you do some rearranging. Okay? So this says that the jump has got 2 components. Actually, this is kind of intuitive. The jump component has 2 bits. One is everything's scaled by the weight that you have in the option, the weight of your portfolio that you have in the option. This is the return on the call option. If you look at this is a return, right? So this is the jump component has a return component due to the call option. And then what's this? Well, this is that Vy tilde minus V. That's almost like the return on, it's the change. It's the change in the asset value multiplied by the call option's sensitivity to the asset value change. CV is the derivative of the call with respect to the underlying. So in percentage terms, that's like a return sensitivity multiplied by the change in the asset value, the change in the argument. So there's a component coming just from the return on the option, and then there's a component coming from the change in the asset value. Okay? Now, so now the trick. So now Merton's trick. The world is incomplete. I cannot eliminate this. I cannot eliminate this, even if I have an infinite number of assets. So what do? Well, we make another assumption. So the assumption what we make is kind of clever. It basically says that the hedge portfolio have jumps which are not priced. There's going to be no price of risk for the jumps. What does it mean? It means that investors do not demand CAPM logic. It's just CAPM logic. Like the beta on jumps is 0, if you like. What it means is jumps are idiosyncratic. They have asset values can jump, but they're not correlated with the market. So they don't, returns do not change. They have no relationship to the market. So I can buy a very large portfolio. Actually, I could expand this portfolio by trading many assets. And then if I can trade many assets, then on average, there's not many jumps happening at any point in time. So what we say is that this is, so in this case, if there's no price of risk, because they're diversifiable, I can diversify away any jump risk, then I still just hold the market return. Well, I've hedged out the return on the market because I got rid of the Brownian shocks, which we assume do have a price of risk. So there's a change. So the jump under P is not equal to, so the dW under Q is not equal to the dW under P. Then what? Well, then I'm back to a world where the return on my portfolio should earn the risk-free rate, even though there's uncertainty. Okay? So there is uncertainty here, but I don't care about it, in which case I just must earn the risk-free rate here. If I must earn the risk-free rate, it means that the return on my, so the excess return on the underlying plus the excess return on the asset must be equal to the risk-free rate. And so that tells me that, well, just rearranging, it tells you that the Sharpe ratio on the call and the assets must be the same. Okay, so which is a tautology because there is no jump risk. Okay, so in a nutshell, the assumption that we make is that jump risk is not priced, and therefore we're just back to a world where the drift of my my hedge portfolio should earn the risk-free rate. Okay, so if the drift must earn the risk-free rate, we end up with getting a new Black-Scholes PDE. So this, I just set all of this equal to equal to R. So all of this just gets set equal to R, and then what do you end up with? You end up with a PDE again. Okay. We defined mu and mu c above. It was on the diffusion summary. Okay, so we're back to this thing here. This is a PDE for solving what the price of a call is. If you take a look at it, the first thing we can do is we can recover. First thing we can do is we can recover the Black-Scholes formula. How? Well, if I set lambda equal to 0, what does it mean? Remember, lambda was the intensity of the jump process. It's the probability that in the next instant there is a jump. So if I set lambda equal to 0, it means there's no jumps. Right? If there's no jumps, have a look at what happens here. Well, that completely goes. And then this bit goes to 0 as well. That would be a 0. And then if you take a look at this, you imagine that the lambdas have gone to 0, you'll realize that you've recovered the Black-Scholes formula. And so the Black-Scholes solution, you plug it in. Okay, but in the more general case, when lambda is not equal to 0, when there is a probability of jumps, the solution, so this is the no jump solution, just repeating for you Black-Scholes. Now, if there is jumps, it turns out that this is the solution. So if there is jumps, Merton shows basically that the solution to this PDE is equal to this. What is this? So let me just walk you through it. Basically, it's a weighted average of Black-Scholes prices. It's a weighted average. So let's take it one step at a time. So this is the option value. I'm just defining lambda dash equal to lambda 1 plus k. Just notation, no other reason, to simplify things. Now if we look at 46, okay, it's 46. When I see 46, I see two components. There's a summation, which goes from 0 to infinity, and this is like a weight. So everything here is like a weight, right? So n equals 0, factorial, there's an n here, there's an n here. There's a lambda, there's a tau for maturity. So this is a number which changes every point in the summation. Actually, it's a big number and then goes to a small number. Okay, so it's weights which are declining as n gets bigger. Now, they're just weights, okay? So it's literally a sum. What's this term? This Bn, well, B, and has a little subscript n. That's meant to signal that it changes for every n. Okay, and what is that B? Well, B, well, that should be Bs, to be consistent with this slide. Bs is the Black-Scholes call option price. So this is just the Black-Scholes price, except two little changes. The input, well, we have tau and d, as usual. But now the volatility term changes with each n. Okay, it actually gets bigger as n gets bigger. Yeah, so the volatility term is changing. And the interest rate is also changing. So there's an adjustment to the interest rate here as well. So for every part, so this is a big summation. Every part of the summation there is a weight in front of this animal here, and this animal here is just the Black-Scholes price, except I change the argument for volatility and the interest rate for every part of the summation. So it's a weighted average of Black-Scholes prices, basically. So it's super simple to compute. However you compute Black-Scholes, you have a function which computes Black-Scholes, right? So if you have a function which computes Black-Scholes, you just need to do a loop where you go from n equals 0 to infinity. Infinity doesn't exist. Actually, you truncate this. That's something like 10 or 20 terms. All right, so you just actually compute 10 or 20 terms. I mean, when I did the pictures, I did 50 terms, but I think it doesn't change if you do go anything above 20. So, right, you're summing up 20 terms. You just do a loop. N equals 1. And just sum all these things up, and then sum them on top of each other, and you're done. Okay? So there's actually a closed form solution to this, which is nice. All right, pricing summary again. How do I think about these things? There's a manager. He has a claim to the asset values. It's a call on equity, or a call on V. Okay? So that's going to be the Black-Scholes call. This is the call with a J. J for the jump. And what is debt? Well, debt is the residual assets are equal to debt plus equity. How do we get the credit spread? Well, the credit spread is the corporate bond yield that sets the bond price equal to its traded value, where D is the face value of debt. So this is just the thing that we've seen time and time again. Like, this is the sort of thing that I will ask you on the exam, right? And then this is the credit spread. All right, so picture number 1. So these should line up almost exactly with the pictures that are in Lando's book, and he discusses the intuition. Here, I've picked an alpha which is negative, log of 0.9. And remember, alpha was log of 1 plus k. So I've picked a k of minus 0.1. K's like, anyway, you can think about things in terms of alpha or k. 0.1 means there is on average, there is one jump every 10 years. So this is like a very infrequent. That's not many jumps happen here, right? That's a low number. Volatility is normal, relatively is normal level. There's the volatility of jump interest rate, standard 5%, and face value of debt equal to 100. And these lines up here signal the initial values of the assets. So the picture I'm showing you here is that when the asset value is very high, that's the debt. So this is a company which has 50% leverage. That's the yellow line. Things are going to 0, and the spread is very small. So very safe companies. This just looks to me like very much like the Merton solution. Let's go now to a company which is highly indebted. So this company has a lot of debt. Okay, so the residual is only $30 at the moment. Okay, now this is cool already, right? Because look, all right, maybe the magnitude is not huge, but look, it doesn't go to 0. So it doesn't go to 0. So we're trying to focus on this part here. So even for this company has a 75% debt ratio, 75. 100 over 150. It doesn't, it's a tiny, but it's not going to 0. Here, it's definitely not going to 0. This is the sort of cool thing that we're after. Okay? This looks like the world we live in. We know these spreads are not equal to 0 at the short end. I know that they're not equal to 0 at the short end, and the classic example is this, right? The iOS, LIBOR minus iOS. LIBOR is a risky loan, right? It's uncollateralized. The swap rates are collateralized. So this is a risk. This is like a corporate yield spread for banks. We know it's not 0, even at 1-day horizon. That is a function. That is simply a property of a continuous diffusion. This is the property of a continuous diffusion. This is the proof that spreads go to 0 if things follow a continuous diffusion. We have just solved the model, or we got the formula for the credit spread in a world where this is possible. This is possible. This could be a bank, right? The value of the assets of a bank. And this could be 1 day to maturity. If there's 1 day to maturity, if this is possible, it turns out that once we calibrate the model, we don't get spreads which go to the 0, which suggests that asset jumps are playing an important role in the real world that we live in. Okay. All right. Now let's play about with the parameters a bit. What do I do here? I've increased the jump size. I've increased the mean jump size. How much have I increased the mean jump size to? Jump. 9. That's clearly not. That number should be. I've increased the jump mean. Question is, how much have I increased it? Cumulative slides. Five. And then I jump on double the intensity. So here, that should be log of 0.5. So log of 0.5 is a more negative number. It's a more negative number. So what does it mean? It means that when we do observe a jump, that jump on average has a larger negative drop. Okay, so that, now what happens? Okay, so this same asset values, 130, 150, 200. 130, 150, 200. All I've done is change the alpha. I've made it, if there is a jump, things get really bad. And here, suddenly, okay, for a very low leverage firm, safe firm, 200, now things are not going to 0, even for the safe firm. This is 75 basis points. Okay, which is not small. Okay, that's getting like close to 1%, even for a safe firm, because now there's even the safe firms can default. So this is what you would. You should think about this yellow line as being a bank. Here, massive default. You know, you can get very, very large. So all of these firms are solvent at this point in time. Here, but we can get very large credit spreads. Okay, very large credit spreads. Again, you have the property that. Now, okay, so actually, when I look at this, I think this is quite good compared to the data, right? So what are the two things that I've been trying to, they're like these, well, there's 3-ish stylized facts that I want you all to take away about the actual credit spreads term structure. What are they? Yep, non-zero credit spreads. Okay, we're good there, right? Now we can get it. And then there's 2 more. One is about magnitudes, one is about shape. Okay. You asked me in the break. Yeah, which line here? Yellow. Did everyone hear that? So the other stylized fact is that if we look at investment grade debt, it tends to be upward sloping, except if you look at that last column, but we ignore that. But it's upward sloping, whereas speculative grade debt is downward sloping, right? Here, we have a downward sloping, and here we have an upward sloping. And the jump is driving that. So here we have, you know, we have non-zero, we have upward sloping, downward sloping, which is good. And what's the third one? So that was like short end, the shape. The other one is the magnitude, which is the credit spreads puzzle. Why is these numbers so big in the data? Why does the credit spreads puzzle, where does that come from? Well, historically, there are not many defaults. We don't observe many defaults. But if you back out the implied default rates from the data, from bond prices, the risk neutral probability of default is very large. I mean, there's not many defaults, but bond prices are telling us that there are a lot of defaults. That's called the credit spreads puzzle. Another way of saying that is why are corporate, so remember this is always in yield spreads, always above the risk-free rate. So if the risk-free rate is 10% and you have a 500 basis point credit spread, it means the corporate bond yield is 15%. So the credit spread puzzle is why are those spreads so large? But actually, we do generate quite large credit spreads here for these highly leveraged companies, right? So this is large. This is 2.5%. This is between 2 and 3.5%. Okay. So I think we're doing a pretty reasonable job here along a couple of dimensions. At least it's much better than the interest rates, right? Interest rate fix didn't really fix very much. And here what happens if I double the jump intensity, so that should be 0.2, and that should be 0.5 again. So this is 0.5, log of 0.5, intensity of 0.1, and this is an intensity of 0.2. Okay, so here's an interesting thing. Yeah, so this is interesting, and I think you're going to see the math of why this happens next week. If you look at this first, this and this, if you look at this and this, okay, if I flip between these two, and you look at the numbers, the only thing I've done here is I've doubled lambda. I made lambda twice as big. If I look at this and this, you just scale it up by exactly 2. That's not an accident, okay? By the way, I think you can get rid of these wobbly bits by using a bigger n. So I summed over n equals 50, but it would be better if it was a large number. I think these would be smoother. But here, all I'm doing is doubling. And that's actually that's a property of jump diffusion processes. We did this thing called a change of measure. The change of measure, lambda under Q and lambda under P are just a multiple of each other. And that lambda enters linearly here. Turns out that lambda is approximately linear in this thing. So the jump intensity just scales it. And actually, we should expect that. All right, so yes. All right, cool. All right, so comments. So I think it's doing a good job. So I think jumps are an important part of the story for credit spreads. They help us understand credit spreads at the small end of at the short end of the time structure. They no longer go to 0, and that's because of this property of normal distributions or continuous distributions versus discontinuous distributions. There's a bunch of other things here now. The recovery rates are not predictable as well. So remember, what is the recovery rate in the Merton model? The assets go, let's say debt is here, assets go along, blah, 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 they end up down here. That is the recovery rate. Debt holders lent B and they got back V. So that's the recovery rate. But that V is perfectly predictable. I can compute the expected value of that V in the next instant. Okay, so I can predict the distribution of V. Recovery is predictable in the sense that in the next instant, I know, well, I mean, the time horizon, as this goes to very, very small, I know what I'm going to get, what I'm going to recover. You know, I'm just going to recover the difference between debt and the value of assets. Here now it's no longer true. Because in the next instant, what can happen is there can be a jump, and I don't know what that's going to be. And that's why we end up with very large credit spreads. Okay? So the intuition is that firms can now default even on a debt contract, even when time to maturity is very small. And you don't know when these jumps are coming. Right? The jumps are not pre-visible, I think is what people say, or predictable. Really matters for high, medium and high leveraged companies. It really matters. And spreads are now close to the data. But I think this is also kind of important. You should think about this as being a bank. And this says that the banks generate upward sloping term structure of credit spreads, and their spreads are non-zero. So this is like the lending rate that Goldman would lend to Barclays, for example, on a one-day basis. It's still non-zero. All right. Let's take another 5-minute break, and then we go through some alternative explanations which are more empirical in nature.
Something that I did before. In the slide, when we trying to derive the jump force out.
Yeah.
I was in the wrong. So from here, okay, so you're saying here you get this part, and then you get to this.
Yeah.
Can you explain again exactly how you?
So this is like a general. This is general. I've said nothing about. At this point in time, gamma can be anything, and y is a random variable. Its distribution can be anything as well. This is true. This is true for. Ito's lemma holds for any gamma and any y, and this will be the formula. Okay, so now if I want to go forward, I need to basically say, okay, what is gamma, what is y? And all I do here is pick some assumptions which make it solvable. The assumptions are that the lambda, the jump intensity, is constant. Just a constant lambda, doesn't change over time. And I said why I picked this, y minus 1, right? Because then I end up with 17. If I end up with 17, stuff like this, that's just y times v. Then I just need to pick a v. So then if this is true, so if these y's are IID distribution over time, this will be the solution of this thing. How should you think about that? That's just the geometric Brownian motion solution. And then there's another part which is just the sum of all these jumps.
But then,
Random variables. Y is always a random variable. Yeah, they're the same. Yeah. Yeah. Exactly. Yeah. Exactly. Actually, I asked you to verify this, but basically, if you do eta on this, using the result I just gave you, you end up with the diffusion that we began with. Verify this is the solution. And yes, D, you can just solve them. That's actually, if you think about it, it's something more. This IID assumption is one which we already also make here. We make IID assumption about Brownians over time. We make IID assumption about jumps over time. It's actually a more general property of something called a Levi distribution, Levi process. So basically, Brownian motion and jump blossom processes are all actually part of some. There's a special case of a diffusion process which is more general, which is called a Levi process. And they just have these properties that IID over time vary in scales with function of the horizon, stuff like that. So anyway, that means we can solve it like this. So then from here, I just say, look,
no, yeah, so it's not normal, then it's distribution, yeah.
log normal, and then we end up with this thing.
And one thing is we saw that term structure could actually be upwards of and shouldn't we see in the mental model the investment, non-investment to go down and pick it up?
Yeah, I'm not sure if this can. I think you can generate lots of.
So, because this is supposed to be like this and it's supposed to go up. So
Yeah.
you could maybe.
Yeah, but you would need more than one jump. I think you can have more.
It has to be positive.
Yeah, you probably need positive and negative jumps. Yeah.
And the positive would be just towards the end. So say that the term structure, so that the.
So you
flow is
maybe
there.
need infrequent large positive jumps.
And towards the end.
Yeah,
No less than 5.
so if they were infrequent, if they're very infrequent, so if you actually look at this one, This has a small jump size and it has a low jump intensity, but not much effect at the short end. There is a bit of effect at the long end actually, because over time, yeah. So if you have a positive jump with a low probability, it will still affect the long end, but won't affect the short end.
So you should make a second jump which is even less probable but has a positive average.
And maybe, yeah.
Yes, you're positive.
Exactly. So my guess is that you have a positive jump, a large positive jump, which is not very frequent.
0.01.
Yeah. And then it's gonna, when it does happen, it really will make a difference, but only at the long end because it's very improbable. So that jumps are a cool way to introduce, play with these things. They give you a lot more flexibility than driving motion.
Quickly, no, just quickly one touch. This is very question. With the drop flow B,
Yes.
B surely or this is your loss in D.
Yeah, sorry, yeah, you recover. This is your loss given. You recover, you get the fee.
I just have a small question. So, from the multi-models, this credit spread is not like it's not the same as the real credit in the market, right? There's no smaller version.
It's smaller. It's not, yeah, but it gets there. It's not too bad.
Yeah, so, my question is like, how are we gonna like estimate how is it credit risk contribute to the rise in the real credit spread in the real world? How do we use, for example, econometrics?
So you could, yeah. So if you think about this, what do you have? You would have. So in the real world, if you wanted to estimate this thing, you would have data, right? It would be like this, right? And then you'd want to. And there are some issues that you don't observe these parameters. You can estimate them to pick the curve to be close to the data. And that will tell you what the true lambda is, what the true sigma is, true. An estimate of the lambda, the sigma, the alpha.
But I mean, like there are other characteristics that contribute to the credit spread, the spread between like the.
Yeah, of course.
Yeah. So how do we? Because I think like those characters change over time.
Yeah.
And then so I want to see like how the credit risk, like the default risk, contribute to the spread over the change over time.
To do that, you need to estimate a model. Choose a model and then estimate it. So, another answer to your question is that in practice, what do people do? In practice, people use this to basically try and understand if a jump's important or not, trying to understand economics. And in practice, what people do in banks or credit agencies is that they use a reduced form version of this model. A model which basically, it's a jump model, but it's in reduced form. Meaning that we don't have any interpretation of what stuff means, but we can estimate the model. And that, we do that next week.
The difference between the first, second, and third. So the scale difference, what's this scale difference between third and second?
So all the parameters are exactly the same, so it's just job to job need. Job intensity. It goes from
So instead of having 10 years after, so instead of 5 years, that's literally the only thing that changes the alpha.
only thing.
I thought you said between the first and second one that the alpha changes how bad the alpha is.
Basically, go from here to here. That goes from log 0.9 to log 0.5.
Just because the intensity is changed.
No, I leave that between this one and this one. The intensity stays the same. I just change the mean.
And then between that one and the second, I don't want to change the intensity.
So like when there's no price of like this part.
This is saying that
So it's like no, I know what you mean. So like basically.
this is just saying that the excess return. It's just saying that yeah. So it's like saying what is my excess? What's the excess return? And remember, what is the expected value of dv over v was equal to mu, right?
Yeah.
Actually, the expected value of dc over c is equal to mu c dt, right? Well, how much what's the expected return on the portfolio, on your portfolio, where you have a W1 in dv So that would be the change in, and you have a W2 times DC. That's actually just, this is mu C DC. So then what's the expected return? It's going to be the expected, that's the return, right? Return on the asset value, return on the option. So my return on my portfolio is a weighted average of these two. So that's going to be W1 times the expected value of this. Let's say the expected DH, return on the hedge portfolio, is equal to the expected value of this stuff. Expected value of this stuff is W1 times the expected value of dV over V. That's just mu dt. Call it mu. And then W2 mu C dt. Okay, so, but that is just like saying W1 mu minus R plus W2 mu minus R plus R equals R. Because W1 and W2
Oh, because
sum to 1.
there's no like money market.
So
Just as normally the third part.
yeah, so if you have so if you have a look, you have we have this amount in the money market account.
Yeah, like it's 1 minus
Yeah, exactly.
W1.
Yeah, exactly. Right.
So that's not like
Yeah. So this is, if you have a look, this is the. I think it's on the next page. No, not this page. Hold on here. Yeah. So like, I mean, if you just take this, if you take the expected value of this, this is the expected value of this is equal to R. That's what that says.
okay, but here like there's no like money market like.
Yeah, because I think this is so this is W1 R. This is minus W1R. This is minus WT R.
It's the same thing.
And this is a 1 R. Yes, exactly. So if you write this out, if you expand that bracket,
Oh, okay. I see.
and then set it.
But like, so there's no like relation between this and like this.
No, because then this basically tells you that what is the this
But
basically.
like this one is also the change in portfolio.
Yes, yeah. So, but now I know it. So I picked the W. So all I've said is that this is the change in the portfolio, right? So that expected value there is equal to 0. So what? Yeah. So this was it's equal to 0. This must earn the risk-free rate. Is what I'm saying. So this expected value, it's just the same as.
But like there's like one more.
Yeah, and that ends up here. That does end up here. So now I'm saying, look, all you have to do, we know what the mu is. We know what the mu C is. It's here. The mu C is this.
Yeah.
We know what the mu of the mu, and then we have a mu from the mu disappears. If you look here. Right, so it's W1 over W2, if you substitute that in here, right, W1 is equal to minus...
Oh, you substitute this into this.
Yeah, using that, exactly, yeah. So if I look, 38 is a condition, right? If I rearrange 38 in terms of W1, W2, I end up with this. Now if you notice, W1 is here, and W1 over W2 is here. So when I substitute that in, the mu minus R cancels with the mu minus R.
Yeah.
Do this for all of the things, and substitute this in, you get 40. Yeah.
Why is it equal to 0?
So I've just rearranged it. This would be exactly the same as Black-Scholes if lambda was equal to 0. So
Yeah, but why this part equal to 0?
no, this part's equal to the risk-free rate.
Oh, okay. Self-financing.
Yeah, self-financing. Yeah. You start with 0, and then
never.
you end up with 0. Yeah. That's it, self-financing competition. Yeah, so the risk-free rate assumption.
Yes, I did like. Super smart guy. I was like, air comes on. He was like, nah, you gotta get it cold if you open the windows. Fucking idiot. So it literally was like 36 hours. And I had to go out in the hall where the transaction and lay on.
All right. So, right, just a quick clarifying question that someone brought up in the break. Okay, where does the magic happen in this model? Like the Black-Scholes magic stuff? Well, the intuition of this thing, remember, is that I cannot hedge out all risk because the world is now incomplete. I can make an assumption that jumps are not priced. Now, if jumps are not priced, we use the approximate. Yeah, so if jumps are not priced, we use this approximate risk-free solution, where we just get rid of the Brownian risk. If you take a look at 38, where did 38 come from? 38 comes from the way we set things up in the beginning. Remember, I started off, we're doing this PDE approach thing again. So 34 says, I choose some amount of my wealth W1, omega 1 in the assets of the firm, and then I have omega 2 in the equity of the firm, or the call, and the rest goes in the money market account. Okay, but then if I look, so if you just look at this, if I take the expected value of DH over H, that's the drift. So that's equal to W1 times the expected value of dV over V, that's mu, the payout ratio. The expected value of DC over C, that's just mu C. Got that by Ito's lemma. This is just, okay, now this is, actually if you multiply out, this is R minus omega R minus omega, R minus omega 1R minus omega 2R. Yeah? So then, that is what that says. That's R minus omega 2R minus omega 1R. I just rewrote the drift in excess returns. That is the expected return on the hedge portfolio. And the assumption I've made is the expected return on the hedge portfolio, if jump risk is not priced, is equal to R. That allows me to rearrange for omega 1 over omega 2. I rearrange in terms of just this thing, 39. I'm just rearranging 38 for omega 1 over omega 2. That's R. So now, have a look at omega over omega 2 and you'll notice something. So here's the Black-Scholes magic. Omega 1 over omega 2 is the ratio of these two excess returns. The denominator is mu minus R. Okay? So then, so the denominator is mu minus R. Plug 39 into 35. Have a look up there. That very first term. It's omega 1 times mu minus R. Omega 1 times mu minus R. But omega 1 is equal to omega 2 times this stuff, but the mu minus r is on the denominator. My point being, the Black-Scholes magic means that once you pick 39 to be true, that mu minus r cancels. The numerator and the denominator cancel each other. That's why the drift of the asset values never enters. And we're only earning the risk-free rate on that portfolio, so risk-neutral world. Okay? So these are the steps. All right. So that's a quick clarification. All right. So this is doing a good job, but in the real world, there are other explanations. Okay? And the two big things that we need to know about. So these are other explanations for problems with the Merton model. The first one is that there is differential treatment on tax. So in the US, corporate bonds are subject at the individual level. So me and you, corporate bonds are subject, or returns on corporate bonds are subject to, or interest payments on corporate bonds are subject to two types of tax. They are subject to tax at the federal level and the state level. So you can think, so there's a London tax and there's a UK tax. That's what that means. Okay? So there's two types of tax on corporate bonds. Meaning if I earn $100 from my corporate bond holdings in a year, the state is going to take some of that money away and the government are going to take some of that money away. Okay? However, treasury bonds are only subject to federal level taxes. So corporate bonds are subject to two types of tax, whereas federal bonds are subject to one type of tax. And what that means is, if I'm a lender, if I'm a corporate bond investor, what does that mean? It means I lend to companies. If I am a corporate bond lender, I will charge ex ante, I will include the interest rate, the tax, differential tax treatment in the rate that I charge to investors, in the rate that I charge to companies, firms. Right, so you have two alternatives. I can invest in treasury bonds or I can invest in corporate bonds. If I invest in corporate bonds, I'm subject to two types of taxes, whereas if I invest in treasury bonds, I'm subject to one type of tax. So what am I going to do? Well, I'm going to bump up the corporate tax rate, or the corporate lending rate. And that's going to widen the yield spread. Well, actually, there's going to be a big tax effect. There could potentially be a tax effect which is responsible for the credit spread puzzle. Maybe it has nothing to do with historical versus risk neutral reporting. A nice argument, and there's a bunch of papers on this that argue that it is an important part of the credit spread. However, there's two arguments that make it an unlikely explanation. The two arguments are that if you think about who is the marginal lender, who is the person which owns the corporate bond market, almost all corporate bonds are owned by pension funds or life insurance. So I think almost all corporate bonds are owned by life insurance companies. Life insurance companies are the major player in the corporate bond market, followed by pension funds and banks. So pension funds, life insurance companies are only subject. They are only subject to federal level taxes. So if you're a life insurance company, you're the marginal investor, you're actually only subject to one type of tax. So you shouldn't have differential tax treatment. That's one reason why it doesn't, it's unlikely to make sense. And the second one is that taxes don't change very often. Taxes remain fixed for years on end. So there's no variation in the tax rate. So variation is another thing that we want to explain, right? Why do credit spreads suddenly go up in recessions? Well, taxes don't suddenly change in recessions. Unlikely that the big changes and swings that we see in the credit spread market, volatility, is unlikely to come from taxes because taxes don't change a lot. Okay? Simple. Yeah. In magnitude magnitudes, it's also unlikely to make a difference because of this thing. Unless we can think about another model in which maybe some things would play out. All right, so taxes, potentially but unlikely story. The other thing to know about the corporate bond market, however, is that it's incredibly illiquid. There is not much liquidity in the corporate bond market. So in fact, most people are most investors who are trading corporate bonds do not trade bonds themselves, but they simply trade CDS. A frictionless world, the credit default swap rate, the premium, which we're going to calculate it in a couple of weeks. Premium that you pay should be equal to the yield spread, the corporate bond spread. People just trade CDS instead, and they do that because trading volumes in corporate bonds are super low. Typically, buy and hold investors buy corporate bonds and then they never trade them after they're initially issued. Who are the typical investor in the corporate bond market? Life insurance company, pension fund, etc. They typically buy the bonds and then they never trade them again. And so the volumes are very low, so is liquidity. So there is a nice paper on this subject by Dick Nielsen, Peter Feldhutter and David Lando, which are all colleagues of mine. They basically do this corporate bond liquidity study using something called the TRACE data set. So TRACE is a data set which I think you have available here at Imperial through the WRDS login, which I guess you should have access to. But basically, it's a very, very large database of corporate bonds, which gives very detailed information about the firm level characteristics of the bonds. So what they do in this paper is like something really super simple, actually. They basically download almost all corporate bond firm level lending relationship characteristics, and they compute yield spreads above the swap rate. Risk-free swap rate. And then they look at very large transactions. Why do they look at very large transactions? Because they claim that these are the meaningful ones. And they want to do something, they look at, they build liquidity proxies. So they build a sort of a liquidity proxy which is like averages of liquidity proxies across all corporate bond categories. And then it's essentially an empirical study. So I'm going to show you a couple of the results from that study. So what are the measures that they're using? How do they build this thing called liquidity? It's an explanatory variable which explains all corporate bond liquidity. So it's called liquidities. It's negative, it means that when it's going down, it means the market's getting more illiquid. So, liquidity measures that they consider are, well, they have transaction data, and the corporate bonds are not traded very often. So you can track when two prices are changing, which is not necessarily consecutively. And you can compute something called the roll measure, which is a measure of the bid-ask spread under some assumptions. You can show that the bid-ask spread is equal to 2 times the square root of the covariance of this number here. Okay? Then there is something called the round trip cost. So if I go into it, the IRC imputed round trip cost is that I enter into a transaction today and then I close it out today in one instant. So in one instant I open the transaction and I close it. How much does that cost me? Well, depends on the bid-ask spread, right? So I sell at the bid and I buy at the ask. The difference between the two is how much that transaction cost me just through going through the market through a market maker. This is an indirect measure of the bid-ask spread. Here is a direct measure of the transaction cost of trading at the bid and the ask. Something called the Amihud measure, which is a very famous guy from NYU who he came up with this, and now he's always been famous for this since. This measures Yeah, so this is a measure of price pressure. So if you have big transactions, how much do prices move? And then we have the standard thing of turnover, which is the number of days in the quarter that a bond is traded. So when turnover is low, liquidity is supposed to be low. And there's another measure which they consider, which is called zero trading days. So they take all of these measures and they compute it for every single bond. Every single bond, right? Because this is based on the prices of, for example, Microsoft 10-year treasury, 10-year bond yield. This is the same thing for Microsoft. This is the same thing for Microsoft, Microsoft, Microsoft. So for every bond, they do that in the entire universe. And then what they do is they take the principal components of this. And they take the first principal component. So what is the first principal component? You should just think about it. All of these measures are on different units, right? So the units of this is different than the units of this. So they standardize everything, and then they take an average. That's simply what it is. Okay? And then this is the regression that they run. So it's a panel regression where they care, in this regression, we care about this one here, the gamma. Right, so all of this stuff is just controls. Controls, 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 controls stuff. After we control for all of this stuff, the swap spread, pre-tax dummies, leverage, the amount of long-term debt, equity volatility, time to maturity, etc., what they care about is whether the gamma here, whether it's significant or not. How should you think about this? Is a panel regression where you're controlling for all of the characteristics of the bond. Does liquidity matter? Where liquidity is an average kind of liquidity thing. And here is the results. So the estimate on gamma is this principal component. It's the average of all of these things. And you have rating categories going across the column. Yes? Sum of squared daily returns. So here you see, okay, so the first thing to say, if we just focus on the very top row, you'll see for all of the rating categories, the factor loading on liquidity is positive, significant at least the 1% level, and it's increasing in magnitude. That's important, right? Because what we know is that the speculative grade and the investment grade debt has the very large credit spreads. But these are the ones which also are most illiquid. Their spreads are loading most on the illiquidity. Okay, so liquidity is having a big effect on the spread. Okay, illiquid bonds, we charge investors charge a larger premium to hold them. Then if you scan through the table, you'll see that actually many of these things individually are not significant, except this IRC measure and the Amihud measure, Amihud risk measure, which is similar to this. Okay, so this is like transaction. So for me, liquidity can be many things. What is liquidity? It's a very vague word. Clearly, it's a vague word here because they've taken a principal component of a bunch of stuff. But for me, what do I care about liquidity? If I'm an investor, well, personally, I know I do care about liquidity because when and if I trade, I always get killed on this thing. That is the thing which ends up being very costly. Have you ever done any trading on your app, your phone, or even Betfair, for example? That's the thing which kills you. Having to trade at the bid and the ask, which are moving around. Okay, so the cost of trading can be very large when illiquidity due to this is very large. And actually, when you look at this table, this is this principal component, but it's all coming from here. It's all coming from the transaction costs component of liquidity. Transacting in the corporate bond market is very expensive, and ex ante people charge larger spreads for it. That's sort of the message here. All right. Also in the paper, what they do is that they show that actually in the crisis period, these loadings are actually much more important in the crisis period. There's also a time effect. crisis period, liquidity costs seem to matter more. All right, so I think we're going to call that a day because this next section is going to take me half an hour. But let me just, okay, so let me warm it up so you can take a look at it between now and next week. I started out at the top of the class saying, so I started out at the top of the class saying that, listing a bunch of problems with the Merton model, additional problems. This is the very first one. I said that when we do option pricing, we can observe the value of the stock on IBM or Bloomberg. We can download data, right, for the stock, and that's how we do option pricing. Now we're using an option pricing framework to understand credit risk, but the input is the value of the firm, the volatility of firm, or the jump intensity of the firm. But we don't observe that stuff. In reality, we don't observe it. We don't know the liability structure, and we do not observe V. So, how do we use this stuff in practice, the real world? Well, there's Merton, who came up with all the solutions. Then there's this other smart guy called Ulrich Wassercheck, the Wassercheck time structure model, the same guy. He was at a Merton lecture in the late 80s and realised that the Merton model could actually be estimated in a simple way. So what he did, he set up a company called KMV with two partners. No one ever remembers the K and the M. They basically start from the theoretical Merton model and they twist it a little bit, apply some data, and actually estimate the V in a pretty simple way. So you can check out their website. They're now called Moody's Analytics because KMV was bought by Moody's in the early 2000s. Very, very large transaction and made these three guys incredibly, incredibly wealthy. So you can take a look at this, but basically it's a very simple thing. It's a three-stage estimation approach, and it makes the observation that, look, I don't observe, the trick is, I don't observe V. But if there's an option written on V, which we call equity, I do observe S. So S is a nonlinear function of V. I don't observe V, but this gives me one thing, one function. So I have one unknown and one function, equity. But it turns out that also the volatility of stocks is a function of V and the volatility of equity of assets. And so they basically solve. You have two equations and two unknowns. So you can end up solving for sigma V and V, and they do this for a bunch of firms, and they produce this table, this picture, which basically tells you something like, if you're in a particular rating category, what's your expected default frequency. All right, so take a look at that before next week, and that's what we're going to begin with. Yeah.
So you say, okay, you have this.
Yeah.
And here you want to find this gamma is significant or not.
Yeah.
And you're saying, so these represent...
These are the estimates, and these are the loadings on all of these.
But are you saying that this is equal to gamma?
Yeah. That is the loading on liquidity.
So this is gamma?
Yeah.
So now you became lambda.
Oh, okay. So yeah. Sorry. This is liquidity though. This is lambda.
So the first one is liquidity.
Yeah. All that should be gamma then. Yeah.
So you're saying so
That one
is significant.
It's significant for all of them.
But the biggest player is IRC because it's the one that
Yeah.
kills all the.
So this liquidity is basically an average of all of these other things. It's roughly an average of all of the other things. And then the question is, where's it coming from? And the answer is mainly coming from
Okay. So you're saying the weighting this one must be the biggest one because we don't play that much more.
yeah, the rest of
If this is equal to all of this, you're saying okay, most of them comes from IRC.
That's it, yeah.
Okay.
Yeah. Yeah. Thanks. Have a good week. Bye. Okay, have a good week.
No, I literally tried. Like, they're super tight.
Like this is a thing. One is
Hello, can I just have your attention quickly? Is there anyone here who's not had their card scanned or signed in? Brilliant, there's just a few people.
those guys.